Olex Network 18, Mission Poshan, Bhavishya Roshan.
.5, 0.6 higher. And the Sensex is opening 250 higher. That's again 0.65 higher.
We are in a situation of consolidation and margins are looking good. Hopefully they will improve as we go further.
Government spend that is keeping the momentum going on, and private investment doesn't seem to have really made a comeback.
Allahabad High Court ruled that the circular will not apply to power companies just for a month actually.
So CBIC chairman in a video conference last week has told all these chief commissioners to start sending notices, tax notices for recovery for non-filing.
Mr. M.K. Jain has been appointed the RBI Deputy Governor for a period of 3 years. Mr. Jain essentially was the CEO at IDBI Bank.
It's not been a good day at all. There are, of course, a lot of pressure points coming in, as we were telling you, the RBI policy this week, etc. All of that has caused the banks to be under pressure today. So the Bank Nifty goes home with almost a 1.5% cut. HDFC Bank leads it with a 3% fall. You have SBI that's down 1.5%, and a lot of the NBFCs, India Bulls Housing Finance and Bajaj Finserv, are your biggest losers, down about 1 to 4%.
Failed to show up on Dalal Street. Nifty closes below 20-day moving average. Sensex falls 200 points but holds on to 35,000. Bank stocks underperform.
The government braces for tighter financial conditions this financial year and a potential rate hike come Wednesday. Sources say that private investment is yet to pick up and only government spending is driving growth. The bond market takes a beating in trade. NBFCs slip today.
Reliance and Infosys back for the bulls, gaining over 1%. Dr. Reddy's does even better with a 3% rise as the company's Srikakulam plant gets US drug regulators' nod.
Fourth quarter earnings have been below par, say top brokerages. CLSA and UBS lower F519 consensus estimates by 3%, pushes hopes for an earnings recovery even further.
HDFC Bank fails to sustain at higher levels despite foreign institutional investors getting a window for further investment. Stock ends the day with 3% losses. Well, those were the top 5 headlines from the day's trading action. Hello and welcome to Markets Today Talk Back, the show where we tell you all about 8 hours of trading, I might say 8 hours of falling stocks today in just 5 headlines. I'm Lata Venkatesh, with me my colleague Prashant Nair. Hi Prashant.
Lata, hi. Bad day, bad start for bulls, this week. Over the next 30 minutes, we will discuss what really drove a trade, what really drove markets. And we'll do that by telling you 5 of the top stories. Our experts will answer your questions. And today we have Deepan Mehta, member BSE and NSE. On the charts, we have Ashwini Gujral. Gentlemen, thanks very much, both of you, for being with us here on the show. But before we start the Q&A discussion, let's quickly wrap up what really happened as far as trade goes. Global markets on Friday, remember, were super strong. We got a good start, but didn't last very long. Lata.
Yes, that's actually the most painful point. You began by saying bad day, bad start to the week and to the June contract. What makes it worse is that the world is not feeling the pain we are feeling. Wall Street ended in the green with strong jobs data. Asian markets chimed. The Nikkei climbed 300 points. European markets are also in the green. But we are in pain alone, and that makes it a very domestic kind of pain. What's going wrong only with India? And what's even worse is that what should have been very good news for us in the form of crude falling to $75, $5 off its recent highs, we are not able to take advantage of that as a tailwind. That's particularly painful. We got, of course, statements from the Finance Ministry, sourced statements that they are worried about a deficit, which means they're kind of throwing in the towel. That's how at least the market read it. And you had yields moving up. An article from the governor in the Financial Times also perhaps raised fears about the rupee. All told, maybe, just maybe, this is a delayed reaction to the bipolls. You know, the bipole results came on Thursday when, came on Wednesday, but Thursday the markets were still in the throes of F&O expiry. And in a delayed reaction, perhaps the market is reacting to potential political instability at the end of a year. We don't know, but banks and mid-caps bore the brunt. So, to take it to stocks?
So public sector banks, private banks, both really led the losses today. Real estate as an index, I mean, actually infrastructure, old economy, basically, under pressure. And you had gains, but very small, feeble gains in sectors like IT, energy, metals, you know, 0.25%, less than that. So nothing significant at all. Large caps which sold off, I mean, so as I said, banks, BOB, DLF, HDFC Bank, Tata Power was lower. We had losses in Bharti, that is Bharti Airtel, Adani Ports, Power Grid, Gas Authority. So, I mean, a fair bit of pressure. I could list some gainers, but nothing meaningful. And then I come straight to mid-caps. Really long list of stocks which cracked and how. So, I mean, here's a sample. PC Jewelers, big losses again. Delta Corp, big losses. Shankara Bilcon has been selling off now for, what, 7 or 8 days. BHEL, you saw a bit of pop and excitement last week, late last week, sold off. And we had, India Cements, TVS Motor, Indiabulls Real Estate, Indiabulls Housing, Infibeam. You know, anything, all of these, anything between 3 and 6%. Large volumes, Escorts, NCC, Praj Industries, Intellect. I mean, so long list, as I said, of decently big losses. And mid-caps, once again, starting the week on the back foot. Lata.
Okay. Thanks for that, Prashant. Let's ask our guests what they have made of the market moves today. First, Ashwini, where do you think the market will move from here? Rather nasty fall today.
Well, you know, today the sense is now coming in that we are not as much related to global cues in the immediate short term, probably the whole of this year. And, you know, inflation and bond yield and RBI policy, rates, politics, that may take front seat, and we may underperform global markets and maybe even come off as they go up. So that appears to be the sense. In the next couple of days, the market is clearly positioning for rate hikes. So all sorts of NBFCs, financials, domestic, construction, etc., infrastructure, those stocks are likely to remain under pressure. Now, the problem is that the large cap indices are almost at, previous highs, whereas mid caps continue to fall. So there is a large amount of distribution which is happening in the market, where for a while large caps don't fall, and finally large caps also join on the downside. So that way, I think because of this HDFC Bank event, the Bank Nifty came off 1,000 points. So out there, much more downside could open up.
Okay, more downside could open up. Mid caps are falling, and Ashwini is now saying, well, large caps also are starting to give way on the downside. Well, let's move on to the second story of the day. RBI's bi-monthly monetary policy review meeting began today. The 3-day meeting may finally see RBI hiking its key lending rate for the first time in 4.5 years. The government, meanwhile, has warned that financial conditions will be tight in FY19. Sapna Das is here with essentially what sources in the government are telling her. Sapna.
Certainly some red flags being raised from various quarters of the government. First, of course, this is going to be a year of financial tightening. You have seen some of the banks actually raise their RPLR during the last couple of days. The question here is that if the inflation trajectory is going up, what is it that the RBI can do? So basically, probably the government is, already readying itself for an eventual rate hike by the MPC. We need to wait and watch and see what really happens on June 6th. The second aspect in terms of growth, here, of course, it's a government spend that is driving GDP numbers. The private investment is still not back. So, the call so far is that even if we achieve the lower end of the growth projection for FY19, it will not be a bad year for the government. The third aspect is the fiscal side. This is expected to be a challenging fiscal year, and 3 major points are being flagged off. First, the oil prices. They're expected to move roughly in the range of $70 to $75 odd. The crude price, that is what the expectation at least is from the government quarters. Now, this is 25 to 30% higher than the last year's average, so that will definitely have an impact. The second, the government is already working out a new MSP mechanism. This could be inflationary as well as have a sizable fiscal impact. Third, the GST collection target is quite stiff for this year. Of course, so far up till May, the government views that they have fared pretty well because it's the beginning of the financial year, but later on down the line, the shoe may start pinching. So these are some of the red flags that are being raised by the government quarters. But of course, the key question is, what does RBI do on June 6th?
Yes, thank you very much for that, Sapna. But I must tell you that the bond markets took this Sapna's news from the from North Block rather seriously. You saw bond yields rise by almost 3 percentage points. They went up to 7.89 at one point in time before softening a bit back to about 7.86, 7.87 levels. The feeling was, what is this? Is, Finance Ministry throwing the towel in terms of fiscal targets? As well, of course, there was also Dr. Patel's piece in the Financial Times. Not that that had anything at all to do with India, but just a feeling that, the external situation also will be in the Reserve Bank's mind when they approach the monetary policy. So looseness or dovishness of any kind can't be expected. Maybe that also is working in the market's mind. You saw yields rise, short point.
Maybe
on a day when crude prices fell.
No, maybe protecting the currency with rate hikes, possibly at some point. I mean, all those things also come into.
No, that's what the market is fearing, and
yeah.
hence perhaps this rise in yields, expecting the hike.
Okay, we got questions. We've got Rajan who's writing in. He's got 300 shares of DHFL. His cost is 525 rupees a share. Would like to know if the stock can hit. Okay, interesting question. If he wants to know if the stock can hit a target of 1,000 rupees in the next 2 years, even after we see, interest rate hikes in the interim. Ashwini, nice way to put that question. Can it go to 1,000 rupees over the next 2 years? DHFL.
Well, the problem with this analysis is that we are entering into a rate cycle which is likely changing and likely to go higher. That way, NBFCs and rate sensitives in general could go through at least a sideways year. If in 2 years, rate cycle again turns down, then maybe, 1,000 is possible. So while it's one of the better NBFCs, but for the near term, if inflation is high, rates are going to rise, then you shouldn't be very positive on financials. In any case, it has done much better than other mid caps. So, just keep a 500, 520 type of stop. And yes, if rate cycle turns 2 years, 3 years, it should get to 1,000.
Okay, thank you very much for that, Ashwini. But the same question to you, Deepan, because, everybody is kind of got caught in NBFC stocks and yields are going only in one direction. How would you sift? First of all, your thoughts on DHFL, and what would be the NBFCs of your choice?
See, getting a target price is a bit difficult, but certainly DHFL will turn out to be an outperformer. It's a very aggressive housing finance company, and only risk factor is the lending which it does to the corporates and the real estate developers. But over there also its track record has been decent in terms of recoveries. And it specifically lends to the middle income and low income groups, and when affordable housing is being given so much of incentive, there may be more business for DHFL to garner going forward. And I understand that yields are going up, but I think NBFCs are managing that particular phenomena. And from an investor's perspective, you have to ride out this turmoil which is taking place in the debt market. At some point of time, I think the yields also will start flattening out and then declining again. It's a cycle. So you have to, remain invested through the cycle. And if you are a long-term investor, as the viewer has said so, then I think DHFL is a company which can certainly give 15 to 20% type of returns over a 3 to 5 year period. It's a secular growth story in a nice industry as well, where there is a lot of demand for the company's services and products.
Well, actually, stay on, Deepan. There is another gentleman also with a question on another NBFC. Neeraj Arora from Uttar Pradesh has written to us with a question. He has 100 shares of L&T Finance purchased at 52 rupees. That looks like the IPO price. He's a long-term investor. He's asking if he can stay put, should he keep or sell.
Certainly, I think an L&T Finance is one of the better NBFCs given its diversity and the pedigree. And what is most impressive is that some of the issues and challenges which were there, now the management has overcome that. And in the areas in which it is operating, it is certainly gaining market share, and it has a unique expertise when it comes to infra finance or equipment finance or project finance for that matter. and it's using that expertise to leverage more and more business. And given its size and the kind of brand, I think it will be better placed to handle increases in interest rates than some of the other NBFCs. So I would certainly recommend remaining invested in L&T Finance at this point of time. And again, this is a company which can deliver maybe 15 to 20% type of returns over the next 3 to 5 years or so.
Okay, thanks for that. Dipan, Ashwini, same question to you. L&T Finance purchased at 52 rupees. It's the sole stock, one of the few NBFCs that is green today on an otherwise red day for NBFCs. Your thoughts?
See, again, similar advice that it's gone up 3 times. Maybe it'll have a sideways year. Whenever it has a bad day, add on to your position. Finally, it should go up to 250, 270. But again, that is likely to take time.
Okay, fair enough. So that is NBFCs. We move on to the third story, the third headline of the day. Among the stocks that were batting for the bulls were Reliance and Infosys. They gained over 1% each. Dr. Reddy's did even better. We saw a 3% rally in that particular name. The company's Srikakulam plant got a nod from the US drug regulator, the US FDA. And Ekta is here with more details on Dr. Reddy's and that plant. Ekta.
Well, yes, a boost coming in for Dr. Reddy's in today's trade. They did receive 0 observations from the US FDA in their API SEZ plant, which was inspected at Srikakulam. So that means that the US FDA does not have a problem with that facility. The last time that facility was inspected was in April 2017. And at that point in time, also, they had received 0 observations. Remember that this facility is different from the other API facility in Srikakulam, which has an outstanding warning letter since 2015. So overall, it is largely a sentiment boost that maybe Dr. Reddy's would now probably forge ahead when it comes to solving the warning letter that they have on 2 of their facilities, considering the past couple of inspections that they've had have gone down positively.
Okay, yes, it certainly has. The biggest gainer in the Nifty today, Dr. Reddy's. There's a question on the, okay, but it's on Reliance actually, the other gainer in the Nifty today. Saumin Bose from Kolkata says that he has been holding 300 shares of Reliance Industries at 950 rupees for 8 years. Speak of long-term investors. Wants to know if he should hold or sell. 300 shares at 950. Deepan, what should he do?
I think it's been long enough time for investing in Reliance and time to throw in the towel. We don't have such a positive view on Reliance per se, given the kind of competition which is there in the telecom industry. So Reliance Jio may not pan out to be as what the street has been expecting. And a lot of the expansion plans more or less have come on stream, and those revenues and profits have also got to an extent captured. And don't really see a trigger for Reliance Industries stock price to move up going forward. So my advice would be to exit out of Reliance Industries. See if you have good position in some of the private sector banks or the consumption oriented stories. I think those will be the outperforming stocks and sectors which investors should target.
But he's bought it before the bonuses, so he's anyway sitting on money. And that's the advice for you, Saumin Bose, from our expert. We take a break on that note. But before we go into that break, here's some market opinion we got from Pramod Gubbi of Ambit Capital. Stay right there. We are back with our experts.
Been a bit dichotomous in the sense that while the index has broadly remained stable, we've seen significantly deeper corrections outside the index in the broader market, particularly in mid and small caps. We would rather hope that even some of the large cap names correct a bit before it starts getting attractive from a valuation perspective, particularly given the sort of headwinds that we're facing from a macro perspective. We would like some of these names to be a little more cheaper than what they are.
We've been taking your questions. Our guests Ashwini Gujral and Deepan Mehta have been answering them. We got through 3 of the top 4 headlines. Let's get to the 4th one. Fourth quarter earnings were not as cheerful as they were expected to be. I mean, if you look at the numbers, CLSA and UBS have actually lowered the FY19 consensus estimates by about 3%. And Lata, this is interesting because, I mean, the general feeling was that numbers actually are a lot better. I mean, they're broadly a beat. But look at FY19 expectations, which have been lowered. So let's begin with CLSA, which has cut full year FY19 earnings expectations by 3%. and they're expecting 20% earnings growth for FY19 and 17% for 20. I remember a couple of months back it was about 25%. FY19 earnings should go 25. We're down to 20 now. UBS has cut FY19 and 20 earnings expectations by 3% and 1% respectively. And they're again at about 20 to 21% for FY19. And you look at Motilal, they're a pat where they were before, so FY19 and 20 expectations remain unchanged, and they're actually the most aggressive on the street. FY19 Nifty earnings, according to them, should grow by 27.4%. So, I mean, there is a 750 basis points difference between what CLSA is expecting and what Motilal is expecting. I mean, so not all that great looking at what has happened to earnings expectations.
Fair point. Actually, let's go to the next headline because, this would be so many questions. We'll need a whole show to handle earnings downgrades. Let's get to the fifth headline. HDFC Bank failed to sustain the day's highs as the stock ended over 3% in the red. This despite foreign institutional investors getting a window to invest into HDFC Bank shares. Abhishek Kotani here with the details. Abhishek.
Over the weekend, NSDL puts a red flag on FII holding in HDFC Bank. So what this means is that the FII holding should be less than 3% of the threshold limit to be put under red flag. So FII's holding in HDFC Bank came down to 72.31% as against the shareholding limit of 74%. So that released about 1.69% of equity, or translating to about 4.35 crore shares that could be bought by FII during the market hours today. But due to excessive buying, the FIIs will need to square off their position over the next 5 days or the next 5 working days. So what this means was that there was profit booking in the counter today, as this news was largely expected that buying from FIIs will come, and therefore you saw HDFC Bank being the main contributor to the Bank Nifty's fall today. Back to you.
Abhishek, thank you very much for that. And we've got a question on HDFC Bank, and Jairaj is writing in. He's got 2,500 shares of HDFC Bank, and he's bought this 22 years ago. And his cost is 10 rupees a share. He's, of course, a very long-term investor. He wants to know
and a very
if he
rich
should,
man.
He wants to know whether he should continue holding or sell. Ashwini, we don't get these kind of questions very often. We do get them. What would you tell Jairaj?
Well, I can tell him how to make it better, although, he doesn't need my advice. But if he's able to increase quantity whenever, HDFC Bank corrects 10%, it does correct 10%. Make that 2,500 shares into 3,500 shares if you have the capital, and then ride it on, because unlikely it'll go below $10. So whenever it corrects, you keep adding to your position, because if you have 25,000 shares and at some point HDFC goes to say 5,000, you tend to make it bigger. So once you are in a good stock, always add on whenever you have extra money and try to increase those gains.
Okay, Deepan, sorry, only 10 seconds left, but what would your advice be?
Remain invested, absolutely. I think no question about it.
Okay, it's like having a house in Altamont Road, isn't it? We have to wrap up on that note. Ashwini and Deepan, thank you very much for joining us, and all of you for staying with us on Markets Today. Ciao.